As Washington wrings its hands over how to prevent the next financial crisis, it appears Wall Street's going back to making money, perhaps in the risky ways that caused the crisis in the first place. Bloomberg's Shannon Harrington is following that story, and he joins us here on set. Shannon, this was one of those things. I read your story. I actually read it twice today because it's on the Bloomberg terminal. What's going on?
Well, what's happening is people are starting to look at a little more complex trades, and because essentially you had such a massive rally over the past year, the easy trade is done. So people have to start being a little more creative, looking at things that are a little more complex to generate more returns. But
we should mention that when you say they're looking at it, that doesn't mean they're necessarily diving into the deep end of the pool, but they're sticking their toe in the water.
They're starting to dip their toes into it. Now, we're not talking about the really, really risky stuff that people were going crazy with during the height of the credit boom, but they're starting to dip back into. I mean, they're pretty complicated trades, but these would be the least complex of the complex, exotic type trades, if that makes sense.
So are the banks taking any steps, though, to make them less risky? In other words, maybe even just changing the name of these, staying away from mortgage-backed securities or, CDOs or whatever, just to avoid any controversy that the name, that acronym, if you will, conjures up? Well, I mean, one thing that Congress and Washington in general has been trying to do for the past year is to sort of rein in, get a handle on derivatives markets generally, and that would include these products. So, they're doing things like bolstering capital requirements. I mean, this hasn't happened yet, but it's beginning, and so the question is, how quickly will they get a handle on this? So where's the demand coming from?
Well, as I said, the demand is from people who,
okay, so the easy trade you said is over.
The easy trade is done, so people now have to get more creative. So these are the
professional investors, the smart money.
Exactly. These are people. These are big investors, sophisticated investors, as they call them in the market, and people who, hopefully will understand the trade. The problem last time was that it got to be so crazy that a lot of people who didn't understand the risks were getting into this trade.
What's the role of the rating agencies this time around?
That's a big question. It remains to be seen. Like the rating agencies have done a lot to rework their ratings models so that there's a lot more confidence in them. The problem before was people were having way too much faith in the ratings, not doing their own homework on these deals. So ratings agencies are coming out with new models, they're improving their models and adding stress tests to them so that people will look at them now and say, okay, well, I believe that a AAA is indeed a AAA.
Shannon, what role, if any, are you hearing from the people you're talking to that Paul Volcker is playing in this? Because we've been hearing from Mr. Volcker the past couple of days. Obviously, he has President Obama's ear, and he says that some of these complex instruments are why we got into this trouble in the first place.
Well, I mean, it's more the same observation a lot of people had last week, that it's interesting that Volcker kind of was at the forefront at that press conference. And, one interesting thing between Volcker and Geithner, or others closer to Geithner, is they really see an important role that derivatives play in capital markets generally. And they're not looking to necessarily regulate them out of existence. They're just wanting to get a handle on them, contain the risks, and so Volcker's a little harder hitting on that point and doesn't see much value in them.
Shannon, in the last, I don't know, a couple of months or so, since this new generation of risky assets, what are we calling them, CDOs, anyway?
I mean, a lot of people think of these as synthetic CDOs.
Okay. How have they
what's
performed?
Happening? I'm sorry?
How have they performed?
They've come back. The stuff that was done before the crisis, if you look at, it's not a very transparent market, so the pricing isn't available.
Still not transparent? Isn't that the problem?
Well, and that's that's part of the issue. Is liquidity was certainly an issue, and transparency. But the prices have absolutely come back. I mean, the stuff that we're seeing happening now is more the very standardized, where there is a liquid market, and you can see the pricing, and those have come back dramatically.
Bloomberg's Shannon Harrington. We should mention Shannon and his colleague Pierre Paulden writing this story on the terminal today. Banks reviving synthetic bets as Volcker blasts default swap. Shannon, thanks so much. We appreciate it.